Well, I think there's a lot of things going on in the world. We have an election coming up in November. You have two candidates that are generally viewed as, one is bad and the other one is worse. We don't want to see these guys run, but, I'm hoping that they drop out. And that's a hope rather than a forecast, And I would say that the debt situation, you're right. I'm concerned. I think we have a system of leadership in this country that has evolved to a leadership out of crisis. On your program a number of months ago, you had Mitt Romney and a fellow from Virginia, Manchin. And they basically endorsed Simpson Bowles, which was, I think, about 8 or 9 years ago. The only problem is nothing was done about Simpson Bowles' report, and the problem is 3 times larger today. But you have no idea when the stuff hits the fan. I remember very fondly how Pete Peterson and Joe Fowler, former Secretary of the Treasury, who was a Goldman Sachs partner, a very real gentleman, ran full-page ads in the Wall Street Journal alerting the public to the evils of the budget and trade deficit. It was 1972. So here we are 50 years later, and the only significance of the deficit is we have the lowest interest rates in the history of the world. So nobody knows when the stuff hits the fan, but ultimately, if deficits don't matter, as some people insist, then I'll be too conservative. But if deficits matter, and I think they will ultimately. I think we're heading to a financial crisis in this country. But we have a deficit that is very large at a time when the economy is reasonably fully employed.
You give the Fed what kind of grades, Lee? And I know you're
I give the Fed a low grade. I think what I would say is they held interest rates at near zero for 10 years. And at the time, Powell said to the public, the stock market is not expensive given where interest rates are. They never bought a ton of people, interest rates didn't belong to zero. Then, very abruptly, in a matter of 12 months, he raised interest rates 500 basis points, stabilized the system. Now they're talking about cutting rates and that the Fed is too restrictive. There's no signs that I could tell of in the economy or in the market that the Fed is restrictive. The stock market is near a high. You're seeing lots of speculation in the market. There's stuff with, I'm not involved, but there's stuff with Trump, the SPAC is an example of the speculation in the market. So I see no signs between the economy and performance and the market's performance that the Fed is too restrictive. I expect we'll get 1 or 2 cuts in rates in the short end. But, the long end, I think, is overvalued, which is a real problem because all the valuation models that one looks at as the stock market expensive relative to bonds, I think bonds are overvalued. Prior to 2008, in the great financial crisis, the 10-year bond yielded in line with nominal GDP. So if you take inflation at 3 to 4%, not 2, and add to that real growth of 2%, you have nominal GDP growing 5 or 6%. And I don't think the 10-year bond would be interesting at 5 or 6%, to me at least. I'm an equity-oriented guy. I find lots of things to do in the market that make more sense than bonds.
Although you have some bonds, let's talk about some of your holdings. Like you're not in cash, obviously. Do you have a higher cash component right now, given your market outlook, or are you fully invested? On average.
I'm pretty heavily invested. I have 15% of my family office assets are in energy, about 20%, and it's something I've been very wrong on timing-wise, but I think, it falls in the category, if something sounds too good to be true, the odds are it's not true, is legato first lien bonds. They're trading around 15 cents on the dollar. It's a complex story, but at the end of the day, I've spoken to 7 major law firms, all say the same thing. The government's behavior here has been disgraceful. 7 years ago, the Department of Defense falsely, and I say falsely, alleged that there was spectrum interference. The only body responsible for setting spectrum policy in the country is the FCC. They studied the allegations for 5 years. After 5 years, a bipartisan group voted 5-0 to approve the use of spectrum. Then all of a sudden, the Department of Defense changed their story. They say, we want the spectrum for national security purposes, and we're not going to tell you why. Okay, I have no problem with that. I'm a loyal American. You just got to pay for what you want. And, and finally, the company, belatedly, in my view, sued the government. They're suing the government for $40 billion. And in their lawsuit, they say they have evidence that the government lied under oath. Not a nice thing. The government basically is using their spectrum without compensation. And the government has made a sale of the company very difficult because of the Turner Amendment, which says that if you own legato spectrum, you can't do business with the Department of Defense. That stuff should be overturned in the lawsuit, at which point I think the bonds go from 15 to par, plus you're getting 17.5 points of PIK interest every year. Now, it's a 144A piece of paper, so it may be too complicated for your audience. I don't know.
Yeah, it's a bit private,
but to me, it's a giveaway.
Give me an idea of what your psyche is like here going into this report, given the history and the most recent declines in shares.
Well, I mean, I think this is going to be this is the most anticipated earnings call in as long as I can remember. So just this time last year, they did 85 cents for this quarter. The street estimates are at 50 cents. So this is not good. They need to come out, or Elon needs to come out, I think, and take a page out of Mark Zuckerberg and stop talking about robotaxis like he was talking about the metaverse. Obviously, they're doing layoffs, which is smart. They got to get fit. But I think that they need to come out with a plan of, we need to get EV sales in line, full self-driving subscription. Let's hear about that. Let's hear about Optimus. Let's hear about all the other things they're doing. Let's not talk about robotaxis. I think if that is part of the narrative, that's part of the narrative today, the stock's going to go lower. I don't think it will be. I think Elon, he didn't go to India. I think he's going to take this seriously. And I think I wouldn't want to be short going into this call just because there's so much bad news already priced in, Scott.
Even if he takes it, in your words, seriously, how do you deal with or reconcile continued price cuts when the street thinks they're done, losing market share in China? You mentioned getting leaner. The whole maybe strategy shift, if you will, this robo-taxi idea, which you don't want to hear anything more about, but you might. And I'm curious what happens if you do. And then just a general EV slowdown. So maybe the goalposts have just moved in a way that you and other bullish shareholders didn't expect them to.
Sure. I mean, the EV slowdown in the U.S., as I've talked about a bunch, are not a big, it's important for like the story, but really it's China. And I still think that's the biggest risk in the name. I mean, as I've told you before, when I originally bought it, I sold calls against it, and which I like to do, which is a good thing to do, I think, in these types of names. But to me, with China, I mean, the Model 3, first of all, Scott, is the #1 selling EV car in the world. And China's growth is still growing. If they can continue to be with BYD, China's a very big market, but they have to have a good plan there. And so to me, that's my concern on the name longer and midterm is what happens in China. I'm less concerned with the U.S. because it's really not that big of an EV market to begin with.
But isn't the writing kind of on the wall, so to speak, in China? If they're already losing market share, the price cuts don't seem to be making much of a dent. And do you have confidence that things are really going to improve there?
Well, I mean, I'm cautiously optimistic. You can lose market share as long as the buyer share is growing, right? So, I mean, you can be a smaller piece of a bigger pie. And so, I mean, China's all in on that. I also think it's only 6% of revenues, but year over year it grew at 50%. Energy storage longer term, it's not going to do anything for the stock today or tomorrow, but that continues to be a narrative underneath, kind of like Apple in the early days. So let me just be clear. I think it's dicey. I've said this before, murky over the next few quarters. Half my position got called away because I do sell calls. But I think that longer term, I'm still want to be in this name, unless he goes all in on the robotaxi. If that's part of the narrative, I'm out. That's, to me, like flying cars. It's just not pragmatic. And so, as I said in the beginning, I want him to channel that Mark Zuckerberg. What he did, that really good pivot at Facebook or Meta, to say we're not going to spend so much. It's easier in an asset-light company, but I think it's going to be a must-listen-to call, that's for sure.
Wow, I mean, you sound, to borrow an expression from our friend Sebastian Page, like a reluctant bull, almost looking for reasons to get out rather than to stay in. But let me ask you this. Given everything you said, and what stuck with me especially is the China story, where you talked about having a smaller piece of a bigger pie. If that, in fact, is the case, then why does Tesla deserve as much of a premium valuation that it was getting before if the story in one of the biggest growth markets on earth isn't what it was?
Well, no. I mean, if you're a smaller piece of a bigger pie, you can have more of a story. I think that, I mean, I've looked at the Chinese market and looked what he's done there, and to me, like on the bearish side, they've literally copied him. Some of these cars have like the black credit card key exactly. So I mean, that's a real pragmatic narrative that I have to think through. But I still think that's the growth engine for Tesla. The cars is in China. And we're just going to have to get to the next 2 quarters. And like, listen, I'm a pragmatic investor. And that's where if he were to go full robotaxi, that's just not realistic, right? So that's not realistic. The market wouldn't like that. And so I would reevaluate there. But I just try to come in and be pragmatic, not dogmatic either way, and just take from the market what it gives me. But I am excited to listen to the call. And I think everybody else is as well. I think the expectations are incredibly low, Scott.
We've got a little bit more on Tesla's results. Let's bring in fast money friend Gene Munster of Deepwater Asset Management. Gene, it's great to have you here. What are your thoughts here? We know the conference call hasn't kicked off and we only just have the releases, so still a lot of questions percolating. But what's top of your mind here?
Well, I think what it's come down to is there's a question, is Tesla smoke and mirrors or is it substance? And I think the results this quarter are going to give evidence for the smoke and mirrors camp to think that this is just another car company. And I think that there is really little to be gained. I think one thing to be gained is that margins are declining, but they're not plummeting. They actually did a little bit better than expectations, still on the decline, but a little better than expectations. So they're going to survive. They got $26 billion in cash, but this ultimately comes down to is, do you believe? If you believe that the future is going to be hybrid cars and it's going to take a long time, 20 years to get to full electrification, stock's not going anywhere. If you believe that electrification, despite all of its troubles now, are going to accelerate for multiple reasons, and you believe in the concept of autonomy and robotaxi and that they're actually going to get this out, Tesla's probably the best position. They are the best positioned company to deliver on that future around autonomy and electrification. It's a big market, $2.5 trillion market. The smartphone market, $600 billion. And so I think that's what this ultimately comes down to. As the panel has said, stock, it's going to move based on what happens on the earnings call at this point, some commentary. I still think the street numbers are coming down for 2024 on delivery, so I think that could pressure the stock tomorrow. But ultimately, this company is going to survive to see this next generation vehicle and to see FSD and see the rising tide of electrification. So I'm still a shareholder. I'm still optimistic. And I think that I just believe in what they're doing from an innovation standpoint.
Do you think the stock movement is justified based on what we got from the release, just on the next gen vehicles and perhaps better than expected margins when everything else was pretty crummy?
No, it's understandable. I mean, you can reason why it's up because people are so desperate for any good news. And given the Reuters reporting more recently that they're canceling this initiative on the 2025 initiative, the fact that they're moving it up, that is a directional positive. But again, I think that 2024 is a throwaway, and stock could keep going down. It could be flat. If you again believe in a future of electrification, Tesla's the best positioned company. But as far as this results, my guess is that stock probably fades in the next 2 weeks, finds its ground, and then as we get closer to 25, starts to rebound.
Hey, Gene, it's Tim. So can we reframe the kind of the investment rationale in terms of either where we're talking about a fair value, whether we're talking about growth versus something? And I can appreciate the dynamics here, which they are so far ahead. It's a technology company, but it does get back to that juxtaposition to they're not GM, but at the same time, they are an auto company. Can you talk about that multiple in Tesla and why you can stand behind that?
So I believe that this should trade at a similar multiple ultimately to Apple. I think that what they're doing around hardware and software, autonomy as a service, I think justifies that type of a multiple. And when you, right now, the multiples, stock's going down because earnings are going down. But on a revenue multiple, I think that is justified. And so why is that justified? Is because we get back into a growth phase. Investors tend to look more at revenue growth than they do at earnings growth. And so if you, just to kind of put it all together, if you build a case that they can grow revenue at 20, 30, 40% as they come out of this trough and do a 7 multiple on that, the numbers you can get to a stock that's double where it is today. And so that's where I get it, is a belief that the growth is going to reaccelerate. And why do I believe growth is going to reaccelerate? Because I think it's an undeniable truth around electrification. I think traditional auto is making some grave mistakes in terms of slowing, which is an advantage for Tesla longer term.
Gene, it's Karen. Thanks for being on today. What do you think the math is around robotaxis? How do you think about it? What is the model there?
So it's pretty powerful. If, again, you have to believe. It's like a religion. If you believe that this is going to get out, I happen to be in the camp that I think that they will eventually get this out. I think, by the way, Lyft and Uber, they're in big trouble if, in fact, Tesla does get this, because anyway, I think that that's a whole different topic. But as far as the impact, we have, they're going to do, call it 2 million vehicles, more or less. If you get to, just for easy math, 1 million robotaxis, a lot of those are going to be Tesla owned. They're actually going to own their own taxis. Some of them will go to third parties. But if you get to that million and assume about 3 rides per day, you effectively can double the operating income. Now, I was just talking about the importance of revenue, but I think that is the math. So that's about $10 billion per year. They did last year about $9.5 billion in operating income. That's with 1 million robotaxis. So that's a lot of them, but that's where you start to get it. The beautiful thing about it is there's a waterfall factor. As you continue to add those cars, the impact to the robotaxi fleet continues to compound.
I want to bring in 2-time Nobel Prize-winning economist Joseph Stiglitz. He's, of course, the former CEA chair, former World Bank chief economist. He's now professor at Columbia University, chief economist with the Roosevelt Institute. He's got a new book out. It is called The Road to Freedom: Economics and the Good Society. And today is publication day, so congratulations. It's nice to have a Nobel Prize winner at the table.
Nice to be here.
I want to talk about this book, and I want to talk about the freedom you talk about in the economy. But I want to talk actually for just a moment about our current economy. In this book, you also talk about taxes and the like, and wealth taxes, and what it means to be free and have a free economy. But I'm curious what you think about inflation, current inflation, and how you think about that in terms of the freedom of our economy and the tax that exists on our economy today.
Well, we brought inflation down a lot. And the key issue back in the years immediately after the pandemic was what was generating this kind of inflation we hadn't had for almost a half a century. And to me, there were a lot of debate about it. And to me, the underlying source, if you look very carefully at what sectors the inflation was in, where it was very clear. It was a supply side shortage generated by the pandemic. It was the war in Ukraine. It was demand shifts. Remember the pandemic, people wanted to live in different places, and house prices where they wanted to live went up, and all of that was the underlying source of the inflation. And therefore, the Fed's response of just raising interest rates wasn't getting at that underlying source, and in some ways made things worse.
So you think it was a mistake for the Fed to increase interest rates?
I think it was a good thing that they normalized interest rates. You know, the zero interest rates that we had since 2008, the cost of capital shouldn't be zero.
Do you think it should stay at where it is today?
No.
What would you do if you were?
I think what they should have done is raise it to a more normal level, 3.5%, and then increase it beyond that much more cautiously than they did. And the implication of that is that where it is today, they ought to be moving it down. It distorts the economy, not only here at home, but globally, when you have such
but you still have you have persistent inflation. I mean, look, Jason Furman's made the argument that if, in fact, the Fed lowers interest rates this calendar year, it is likely because we actually have an employment problem or an unemployment problem rather than a true inflation, that inflation's actually coming down.
Well, as I say, go back to, does raising the interest rates actually address the problem? And what should be our target? Now, remember, in terms of target, 2% number, that was pulled out of thin air. There was no economic science behind that. No economic science says how fast you should go back to whatever goal, arbitrary as it is.
You think the credibility of the Fed matters? Doesn't matter? Does a 2% target matter?
The credibility of the Fed should be based on overall, are we keeping inflation within guardrails?
Right.
And everybody realizes that we don't have runaway inflation. We're not Argentina. You know, we have a stable economic system.
It's insidious long term. Right. It can be insidious long term if it were to stay at 4 or 5% year after year.
If it started getting higher and higher, that would be, you're absolutely right, that would be insidious.
It compounds.
But if it comes down to 5, 4, and then it's drifting down to 3 and 2, that's fine. Let me explain why a little higher inflation overall would actually be good for the economy, because what we've observed for a long time is what we call downward rigidities.
Right.
Very hard to get wages to fall.
Right.
And when you're an economy going through, you know, big structural change like we're going through, AI, the green transition, then you need to move labor capital from one place to another. What guides that movement is changes in the relative prices. And when you can have more movement in that relative prices, which you can do with downward rigidity if you have a little bit higher inflation target, gives you a lot of better ability to move resources without high unemployment.
Let me ask you 2 very quick questions about this book. You write the following about economic freedom. You say that that phrase is even misunderstood because you say that right now we don't take into account both sides of that freedom. You say the freedom to harm others, for example, or the freedom not to be harmed. Too often we have not balanced the equities well. Gun owners versus victims of gun violence, chemical companies versus the millions who suffer from toxic pollution, monopolistic drug companies versus patients who die or whose health worsens because they can't afford to buy medicine. And my question to you about that, about this balance issue, is if we were more cautious on one side on all of those issues that you just described, and I think there's folks who would like us to be more cautious, what happens on the other? Meaning there's an argument made, I think less so with guns, but let's go do it with medicine, that you want people doing new innovative things in science on medicine because of the lives that could be saved. And how do we think about that balance?
Yeah, you're right. These are very hard questions of these balances. In some cases, I point out in the book, it's pretty obvious which is more important, the rights of the exploiter or the rights of the exploited.
Right.
But the kind of cases that you mentioned are the hardest, and that's where economics comes really to bear. What is the process by which most drugs get produced?
Right.
And think about the most important one we've had in recent years, the vaccine that protected all of us against COVID-19. That was almost all funded by government. Government funded the basic research that created the mRNA platform.
Right.
And government funded most of the work then going from that mRNA platform to the vaccine. And the last mile was done by the private sector. They would have done that if their profits had been 1/10 of what they actually got.
More Tesla with Tasha Keeney of ARK Invest and Steve Wesley of the Wesley Group, also a former Tesla board member. Welcome, both of you. Steve, I'm trying to figure out how you get out of if you're Tesla, you get out of a price competition, cheaper Chinese EVs situation by, through price cuts and a cheaper car that has aspects of the current platform. What's the optimistic scenario here, Steve, that you see?
Look, you've got to get a $25,000 car out to market. And let's be honest, this was a terrible quarter. Year-over-year decline in Q1 sales haven't happened in 4 years. Poor Cybertruck numbers, increasing competition from BYD, Hyundai, Kia, 40% decline in share price. It doesn't get much tougher than that. On top of this, Elon's putting huge amount of pressure on the big August 8th robotaxi event. And my gut is anything less than an earth-shattering news on full self-driving and no 25K car could trigger a sell-off. Right now, Tesla needs to focus, and they need to get dates for bringing that new $25,000 car to market. If they do that, there's a lot of silver lining out there for them.
Tasha, your price target on Tesla is more than 10x up from here. So what is it that convinces investors in this situation that Tesla is worth that?
Yeah, well, let's talk about earth-shattering. I can't think of anything more earth-shattering than a car that drives itself. And I think that's exactly what people should be focused on. So, yes, our previously published price target was $2,000 per share by 2027. We're updating that now, so look out for that research. But we think that 2/3 of the enterprise value in that year could be attributable to a robotaxi network. To ignore this is crazy in my mind. I think that this Tesla will be one of the greatest AI companies of our generation because of this. What's important now is we're hearing, that they're investing in compute. They're mentioning in the letter that, compute resources up 130% for the quarter. They'll continue to invest in compute. We want them to do that because the way that they have tuned the full self-driving neural net architecture is such that, they have this amazing data set, millions of cars on the road, over 2 million miles of driving data per day to train from. And, for a while they were compute constrained, and that's not the case anymore. So basically, new problems arise and they just need the compute to solve it. And now they're have that, or at least have line of sight to having that. I think that's huge. So I'm super excited for the robotaxi event later this year.
Okay. Steve, I mean, to even get, let's put the regulatory approvals that are going to be necessary aside for a moment. To even get to true autonomous driving and the realization of this on a mass scale in a way that's potentially financially meaningful for a Tesla, how much hinges on the fact that you need a lower priced car, you need scale, more vehicles on the road to fully deploy full self-driving and to fully realize software and services?
No, you and what Phil just said is exactly right. Robotaxis will be the biggest deal in the world, but that's 5, 10, 12 years out. That's just aspirational talk. Tesla's got to figure out what they're doing for the next 3 years. And the short answer to that is the $25,000 car. Drive a Tesla, full self-driving. It's extraordinary. And Tesla and Waymo are the leaders. Let's give them credit. But they're at maybe 98, 99%. Before you have full self-driving robotaxis, you have to be at 99.9999. That is years out. Tesla's got to fill that gap. There is some silver lining here. Look, they still control 51% of the EV market in the United States, more than all other companies combined. That's great. They're dominant in Europe. They have work to do in China. That's why they're bringing prices down. They control the charging network, largely in North America and Europe. All other automakers are gravitating. They're going to use Tesla's network, and I don't think Tesla will be bashful about raising prices there. And their energy division is growing at record rates, $6 billion last year, should be at $10 billion by the next couple of years. And there are a lot of talk about their new out-of-box manufacturing process that could cut costs another third. So lower battery costs, better manufacturing, some silver lining, but they're going to have to scramble to get through this next 3 years because full autonomous driving and robotaxis ain't going to be here anytime soon.